Your business is completely legal. Your team is brilliant. Your investors believe in you. And the bank just said no. If you're building a fintech startup right now, there is a very good chance that a bank has already rejected you, or is about to. And the worst part? They won't even tell you why. No explanation. No appeal process. Just no. Today I'm going to tell you exactly what's happening behind closed doors. Why banks are shutting fintech companies out. What they're actually afraid of. Because nobody talks about this openly, and they should. Let's paint a picture. A recent report revealed that 95% of payment service providers in Europe have seen their accounts closed or restricted. 95%. Barclays, rejected. HSBC, rejected. Lloyds, we'll be in touch. Spoiler, they won't. Here's the thing. This isn't a glitch. This isn't bad luck. This is a deliberate policy of de-risking. To understand this, you need to think like a bank's risk team. They operate on a risk appetite that increasingly excludes the entire fintech category. The recent collapse of Synapse has only made it worse. Banks are terrified of the ledgering failures that left thousands of users locked out of their funds. Regulatory pressure is intense. We're seeing dozens of cease and desist orders targeting these partnerships, forcing banks to pull back. From a bank's perspective, by saying yes to you, they're saying yes to everyone you serve. And they don't know who those people are. It's not just volume, it's bias. Algorithmic de-risking is flagging medically accurate terms as high risk, leaving entire sectors like Femtech completely unbanked. After being hit with billions of dollars in fines, banks aren't managing risk anymore. They're just cutting entire industries to play it safe. Third, they don't have a box for your model. Their legacy systems can't reconcile your proprietary ledger with their traditional assessing templates. If they can't put you in a box, the default answer is no. Let's look at real cases. One regulated UK startup spent 11 months in limbo before being told they were outside the risk appetite. 11 months. That's not an outlier. That's the new average. The wait times are literally strangling innovation before it can even start. We've seen fully licensed exchanges have their accounts closed with just 30 days' notice. No warning. Just a scramble to save their clients' funds. Even if a mid-tier bank wants your business, their correspondent bank sitting above them can pull the plug. It's a cascade of no that you never even see. Banks aren't just looking at you today. They're pricing in the risk of you actually succeeding at scale. Your growth scares them. The person you're speaking to can only say no. The real decision is made by a risk committee you will never meet, who review your vision for 15 minutes. Banks don't just look at today. They look at what you could do at scale. Your future scares them. So what's the solution? Stop targeting traditional retail banks. They were built for a different era. You need to look for EMIs. Institutions built for this era offer named IBANs, multi-currency accounts, and most importantly, a compliance team that speaks your language. Get your compliance house in order first. AML policy, UBO structure, source of funds. Show them you manage risk better than they do. The traditional banks closed the door because they couldn't figure out how to manage the risk. That gap is being filled by new financial infrastructure. If you're building a fintech or struggling with your banking relationships, I help companies navigate this landscape and connect to the right institutions. You can reach out via LinkedIn, email at info@finlogic.hk, or visit our website at finlogic.hk. If you've been knocked back, it's not your fault. Drop a comment below and hit subscribe. The system wasn't built for you, so build around it.